I've introduced you to the financial statements and a framework for thinking about how they relate to each other. But how do business events and transactions actually make their way into the financial statements? Let's talk about the accounting cycle. It's very important to understand the progression of the accounting process so we can understand each of the steps we'll be taking in the upcoming videos. This accounting cycle occurs every accounting period. Since most companies have to prepare financial statements and issue a quarterly report, we will see the accounting cycle happen every quarter. But since a company has to prepare financial statements and file an annual report, or a 10-K, this accounting cycle also occurs every year. Let's talk about the steps in this accounting cycle. The first thing a company does in the accounting cycle is to analyze all the events and transactions that have happened during the accounting period. Let's use a year as an example of our accounting period. And then record those in the books. We call that journalize and post. Then, after all of the transactions and events have been recorded in the books, the company must record something we call adjusting entries. These are entries that are made under accrual accounting due to the passage of time. After those are completed, the company can prepare its financial statements, the balance sheet, the income statement, and the statement of cash flows. And then, if the company has used temporary revenue and expense accounts to record its revenue and expense entries, it must close those to the retained earnings account. And then, the cycle starts all over again.